Hello, and welcome to this presentation about the new Accounting Lease Standards issued by the FASB, presented to you by Bowers and Company Construction Services. I'm Bob Teska, and for the next 30 minutes or so, we will be delving into this exciting landscape of what's to come for the leasing world. This began, much like the revenue recognition standard, as a convergence project between the FASB and the International Accounting Standards Board, with the hopes that basically they would come out of this with two standards that were pretty much identical, so that here in the U.S. and then internationally, the leasing standards would be the same and financial statements would be comparable in that light. They were able to do that pretty well with the revenue recognition standard, but with this one, they were not. And so the two issued standards have some significant differences, so they are not converged really at all. And then on another note on this, I do think so many people were caught up in, it was Chicken Little, the sky is falling with revenue recognition, that with the leasing standard coming right behind it, they kind of fell asleep on this. They were so focused on that one, they didn't really take time to learn this. And I think this standard has the possibility to affect more balance sheets in the operation of the company and what you see when you're analyzing financials for bonding and banking purposes than the revenue standard did. Having implemented the revenue standard, it's largely a non-issue for a lot of companies, especially not non-public companies. And about half of the publicly traded companies that implemented the new revenue recognition standard, it was really a non-event for them as well. So this one, though, this is going to have, I believe, far-reaching effects for all companies, public and private. So just looking at an outline of what we're going to try and cover today, we're going to briefly review the current lease guidance, what's in effect today. Then we're going to move into reviewing the new leasing guidance. There's a couple of carve-outs for short-term leases and also some related party leases. Then we'll look at whether or not you actually have a lease or not, because that's going to be really important as we decide how to treat them. Then we'll look at how we account for the lease, and then there's going to be some other items, and then some examples. The examples, I think, are really going to bring this home for you. And I'm going to apologize now because kind of in the middle there is a lot of minutia, and if you fall asleep, I will understand. Just wake up when we get to the examples. All right, so leases. So who did this to us? That would be the Financial Accounting Standards Board, and what they did is they changed the leasing standards for both the lessees and lessors. However, I will say that the lessors have very few changes. Most of your changes is going to the lessee side of this. So we're not even going to talk about the lessor side. Why did they do this? Well, there was a substantial amount of companies hiding a substantial amount of liabilities off their balance sheet by having them structured as operating leases. Now, they were fully disclosed in the notes to the financial, but a lot of people weren't smart enough, I guess, to flip to the notes, then add them back to the balance sheet. So, they were hidden, I say in quotes, and that led to this standard. And when is it effective? Well, if you're a publicly traded company, you're actually issuing statements right now for 12/31/19 that have the new leasing standard in it. If you're a public or a private company, rather, we were actually just given an extra year to implement this. It was supposed to be effective for statements that would be issued 12/31/20. However, with the extra year, it'll now be in effect for 1/1/21, which means you won't see it in your financials that you guys review until 12/31/21. So there's a little bit of time, but not a ton. All right, so looking at the current lease standard, starting from the left and kind of working over to the right of the slide here, we're going to look at the balance sheet, and then moving to the right. If you have a capital lease, you're going to have an asset on the balance sheet and you're going to have a liability on the balance sheet. The asset is going to be depreciated or amortized like any other asset, and you'll see that depreciation expense in the income statement. And then with the lease liability, that's going to be written off just like you would a normal long-term debt. You're going to make payments and you're going to reduce principal, and there's going to be interest expense. But sliding further to the right, if you have an operating lease, there is no balance sheet recognition whatsoever. Going down a row on the income statement, like I said, on the capital lease, you're going to have interest expense and amortization or depreciation expense. For the operating lease, you're just going to have rent or lease expense, and it's just going to hit the P&L every month or every year as you guys are seeing it. And for the cash flow statement on a capital lease, you're going to have principal payments on the liability recorded as financing activities in the statement of cash flows. And then on the operating lease, there will be no recognition on the cash flow statement. All right, so currently, if you have an operating lease of any sort, you should have a note in your financial statement that looks something like this. In this note, the company is leasing warehouses and office space through 2024. They're also leasing some delivery vehicles through 2022. They have various payment arrangements, and the payment structure for the next 5 years and thereafter is at the bottom. So while the liability isn't on the balance sheet, you can clearly look at this note 7 here and you say, oh, look, I should have a current liability of $586,000 and a total liability of 2.1, almost 2.2 million. But like I said, this was difficult for people to do, so we have the new leasing standard heading our way. And with this note for the operating lease, what I always assumed happened, or at least I was told, I read what happened when you guys would do underwriting for bonding, is you would take a balance sheet and you have the as reported column on the left, and you would make an adjustment for these operating leases. So we have an adjustment of $586,000. Essentially, that's a current liability because that's what's going to be due on the operating lease over the next 12 months, which bumps your your current portion of long-term debt, in this case, up to $924,000. So what's happened is your current liabilities in total have gone up about $600,000, which means your working capital goes down $600,000, and that means it affects your bonding capacity. So this is what I thought happened. I gave a brief presentation on leases about a year ago, maybe a little more, to a room full of sureties, and in discussions after, I was shocked at how many of them told me that they do not do this analysis. Some very large surety companies with great reputations essentially ignored this liability that was in the notes to the financial statement and underwritten bonds based on purely what was in the as reported column. So because of that, I guess I can understand why this leasing standard might be a good idea. All right, so now we're going to move into the new leasing guidance. So again, we're going to start from the left and we're going to work our way to the right, starting with the balance sheet. And under our finance lease, that is what had been called a capital lease. And the finance lease and the capital lease are very similar in nature. You're going to have on your balance sheet now, instead of having the asset that's being leased grouped with your regular property and equipment, you're going to actually have a line item that says right of use asset. And that's going to be your leasing assets. And then you're going to have a corresponding leasing or finance lease liability in the liability section of the balance sheet. On the operating lease, moving over to the right, you're going to have that right to use asset, and you're going to have an operating lease liability. So remember, before in the operating lease, there was no balance sheet recognition. Right here, we've got a balance sheet recognition for the operating leases. And the income statement for the finance leases, same thing. We're going to recognize interest expense, and we're going to have amortization of that right of use asset. So, almost identical to the capital lease situation. On the operating lease, we're going to have a single lease cost. It's going to be straight lined over the term of the lease. So you're going to have P&L activity similar to what you had in an operating lease before, where it's on more of a straight line basis as opposed to being amortized off of like an amortization schedule for long-term debt. And then on the statement of cash flows for the financing lease, again, very similar. Your principal payments on the liability are going to be a financing activity. And if there were any additional variable payments for interest or variable consideration, those are all going to be operating activities. And then on the operating lease, all the cash payments are going to be in the operating activities. All right, so a couple of carve-outs. If you have a short-term lease, and a short-term lease is described as a lease that's in total is less than 12 months, you can elect not to apply this lease guidance to it. So you can just essentially treat it like a rental agreement, and you're just going to book the rent payments or lease payments each month. Now, a lot of people have said, okay, that's great. I'm going to structure all my leases so they're 12-month leases with 12-month renewals, and I'm not going to have to follow the guidance. You know, the FASB is kind of wise to that, and they say if you're reasonably certain to extend these options, then it's not really a short-term lease. So you can't really structure a lease in a way where it's always short-term and you're not going to, recognize it on your balance sheet. One of the other carve-outs that I think is particularly beneficial, especially for construction companies, if you have a related party where you're leasing from, like for instance, a lot of companies will have an LLC where they own the real estate, and then the operating company rents from the LLC. But a lot of times these agreements are informal. There might not be anything in writing at all. It's just every month we make a payment of $2,500 to the LLC, and that covers the rent. It's really a way to get money out of the operating company for the owner. If you have an agreement like that through a related party, and there isn't really any legally enforceable terms and conditions in the lease, essentially it's verbal, it's just, we're doing it, and if cash flow ever got tight, we could not make the payment and it's not a big deal. We can account for that lease, even though it has a duration of, till whenever the building is sold or the owner says I'm ready to transition out of this, but you can account for that as a short-term lease, meaning you don't have to put any of that on the balance sheet. So that is going to save a lot of headaches for a lot of my clients. All right, so now we have to look at what happens under these new lease guidance and deciding whether or not you have a lease, because there's a couple of steps that we have to go through. First, we have to decide if the contract we have does contain a lease in it, and then that's directed by if you have control of the asset, and then if you have control of the asset, can you direct the use of that asset? And if both of those criteria are met, then you have a lease. And once you've established, okay, I have a lease, then you go into a decision tree of, do you have a finance lease or do you have an operating lease? And the way it works is you go through these criteria to see if you meet the criteria for a financing lease, and if you don't meet those criteria, you by default have an operating lease. So we're going to go through that a little bit here. So the question is, do you have control? And it's control of an identified asset. It's very strong in the language that the FASB wrote that it has to be an identified asset. It can't be vague, and there can't be options for the lessor to just come and swap out the asset at any time unless it's swapping it out for like a nearly identical asset. But if there's a lot of vagueness in there, and it's, we could give you this or we could give you this other one that's sort of like it, then you really don't have control of that asset. And if that is the case, you don't have a lease. But control, if you have control, two conditions are met. You have the right to obtain substantially all the economic benefit from the asset, and the right to direct the use of the asset. And so what does that look like? I am not going to read this whole thing to you, but obtaining substantially all the economic benefit comes down to you having the exclusive use of the asset throughout that period that you're leasing it. So if that's the case, you have exclusive use of that asset, you control it, and then you might have a lease. So then you have to go to step 2. And so step 2 is, do I have the right to direct how and for what purpose the asset is used throughout the period of use or throughout the period of this contract? Essentially, the lessor isn't restricting how and where you can use this. They're not saying you can only use it, from 5 a.m. to noon on Monday, Wednesday, and Friday. You have unlimited access to this. So as long as you're not restricted in both, so you have control and you have the right to direct the use of this asset, if the answer to both of those are yes, then you have a lease. So we establish that we have a lease, Now we have to establish what type of lease that we have. And like I said, it's a decision tree. First, we go through and we figure out, do we have a financing lease? Does the contract have the criteria that would deem this a financing lease? If not, then it's an operating lease. So you have a financing lease if any one of these 5 things show up in your contract. One, if at any point there's transfer of ownership at the end of the lease term, that automatically makes it a finance lease. If there's a purchase option and the lessee is reasonably certain to exercise that option, then it would be treated as a finance lease. And you'll notice a lot of the wording in this is reasonably certain, substantially, major part. Yeah, a lot of this, it's written very much like the revenue recognition, where there's a lot of subjectivity and judgment given to this. So are we reasonably certain that on the outset, when we lease this piece of equipment, that we're going to buy it at the end, regardless of if it's a bargain purchase or not? If there's the option to buy it and we think we're going to, it's a finance lease. If the lease term is for the major part of the economic life of the asset, then it's a finance lease. If the payments that you are making are substantially equal to the value of the piece of equipment, it's a finance lease. Or if it's incredibly specialized in nature, there's no other use for it at the end of the term, then it's a finance lease. So if those things, any one of those are not met, but we've already determined it is a lease, then if none of these 5 things are met, we have an operating lease. So we're going to first start with looking at how you account for a finance lease. And I'm sorry, this is where it does get kind of thick in accounting terminology, but I will try to get through this with a little bit of grace. Our initial measurement, how we're going to put this asset and liability on the balance sheet, very important. The finance lease liability goes on the books as the present value of the lease payments. So all the lease payments you're going to make, you do a present value calculation, and that's the liability that goes on the books. However, you have to take into consideration the renewal options. So if you have a 5-year term lease, and then there's 3 3-year renewal options, at the outset, you have to consider how many of those renewal options are you going to actually reasonably likely to renew. And if the answer is 1, then you would put a lease liability on the book for 8 years, 5 years initial plus the 1 3-year renewal option. And then you put the right of use asset on the books. That's also a present value of the lease payments, and you adjust that for any prepaid lease payments or initial direct costs, lease incentives. Again, you consider the renewal options. If there are none of these more complicated issues where there's no direct cost or lease incentives and you're not prepaying any portion of it, your liability will equal your asset. But if there's some of these other things where you have initial direct costs, which could be training, setup, installation, if any of those costs are in there, that's going to just make a difference between your asset and liability at the outset. And then a note on the present value calculation, it should be used the implicit rate in the lease. However, that is almost never available. So if it's not available, you can use the incremental borrowing rate of the lessee. That can be calculated based on like bank debt. Or if you're a non-public company, you can just use the risk-free discount rate, which is usually like the 3-month treasury note. So subsequent measurement, meaning after you initially record it, now what do you do with it? So you reduce the principal amount of the lease liability, and you're going to record interest expense right off of an amortization schedule like you would for any piece of long-term debt. And then on the right of use asset, you're going to amortize that as well, and you're going to do it over the earlier of the end of its useful life or the end of the lease term. Unless you're going to purchase it, then it's going to be the end of the lease term. So what does that look like? So if we have a quick example here, we've got a lessee entering into a lease. Its initial term is 10 years. It's $50,000 payments, and there's initial direct costs of $15,000. and we're using the incremental borrowing rate of 5.87% because the implicit rate isn't known, and all payments are payable at the beginning of the year. So this has got a little bit of kind of funkiness to it, where you've got those initial direct costs and the payments are due at the beginning of the year, meaning you're going to make a payment essentially when you sign the lease. So what happens is, on the commencement date, the lessee determines that they're not likely to use that 5-year extension. So we're going to just use the present value of the 10-year lease payments. And the lessee makes the first payment essentially when they sign the lease. So then there's 9 more payments that are going to be discounted back. And you measure the right of use asset using the same PV calculation. However, you've got a difference here because you add those direct costs to the right of use asset, and also the lease liability starts out at $342,000 because you made that first $50,000 payment. So the asset is essentially the $342,000 that's on the books there, plus your initial payment of $50,000, plus those initial direct costs. So the journal entry that goes on the books is you record the asset of $407,000. You record the lease liability at $342,000, and the cash out the door is the initial $50,000 payment plus those direct costs. So the finance lease asset is amortized on a straight line basis. So you're going to amortize that off $40,702 over the 10-year period, like the amortization schedule shows. And then the lease liability, like I said, that liability is $392,000. We made the initial payment of $50,000, which gives us $342,000. And then you accrue interest the first year, and that bumps the liability up to $362,000. But then in subsequent years, you're making those $50,000 payments and accruing interest, and so the lease liability works its way down. All right, so an example journal entry for the first year of payment, you're gonna, or at the end of the first year, you're gonna amortize the asset by $40,000. Like I said, that straight line, you're gonna record interest expense of $20,000. You're going to amortize the asset accumulated amortization of $40,000, and your liability will be reduced by $20,000. And then what's not shown here is the cash going out the door, $50,000. All right, so an operating lease, kind of similar. Your initial measurement is the present value of the future lease payments. Same thing, you've got to consider a renewal options. How likely are you to extend the lease beyond the initial term? And then the right of use asset is the same present value of the lease payments, and you adjust that again for any prepayments, initial direct costs, or lease incentives, calculate or considering renewal options. And the same interest rate rules apply. You use what's implicit, the incremental borrowing rate, or for non-public companies, you can use that risk-free discount rate. So an operating lease on the subsequent measurement, again, as you're making payments, so your lease expense is going to equal the incentives plus the indirect cost divided by the lease term, meaning that your lease expense on a operating lease is going to be straight line, so it's going to be the same every year. The liability is going to be reduced by the principal amount based on an amortization schedule, and then the right of use asset is decreased by the it's essentially a plug between the difference between the expense and the liability. So here's an example of an amortization schedule. It's interesting to point out that the lease liability is going to be the same for a finance lease or an operating lease if it had the same term. So that column isn't going to change. The direct costs, they're amortized off on a straight line basis. So this example here is the operating lease at the end of the year. You're going to have lease expense of $51,500, and that's your $50,000 payment plus 1/10 of the initial direct cost. You're going to reduce your lease liability based on the amortization schedule, and then, like I said, the right of use asset, that's a plug basically. It's the $51,000 minus the 20. It doesn't really follow an amortization schedule. I think the FASB doesn't call it a plug, they call it a calculation. but it's really a plug. So subsequent, if there's any lease modifications after you've initially recorded it, your term gets extended, there's change in consideration, the payment changes, something might terminate, there could be an additional right of use asset that wasn't part of the original contract. You would change the value of the lease, kind of going through the same process. There are disclosures that are very similar to what's disclosed currently. The type of lease, you aren't allowed to combine on your balance sheet the operating and the finance leases. Those have to be separate, and there'll be separate disclosures for both of them. And then kind of the nature of leases. Again, this is really similar. General description, like what are you leasing? How long are the terms? How long do they extend? How many renewal options did you opt for? And any covenants. So that's all pretty similar. And then you have two options for transitioning into this. Full retrospective, which means you would essentially do a restatement of all years presented on the financial statement, all prior years. I can't imagine too many people are going to do that. I would lean heavily toward, I know our firm is going to adopt the modified retrospective, where you adjust opening retained earnings of the current year for any effect that the leasing standard would have. There'd be a couple extra disclosures that you would have to add if you did that, but this is going to be more efficient doing it this way than to restate everything. All right, if you have fallen asleep, now would be the time to wake up, because I think these examples that I have here at the end kind of bring everything together and will show you how much of an effect this could have on a company's balance sheet. So we're looking at an operating lease example here because there isn't a ton of change in the finance leases and between a finance lease and a capital lease. So, we have a balance sheet here, and then on the first column is the current standard, where there's no operating leases on the balance sheet. And then under the new standard, I've plugged in, you can see the right of use asset up in the asset section of about 2.1 million right here. And then you can see the current portion of that of 586,000, and then the long-term portion of 1.6 million. So we have increased our current liabilities and decreased our working capital. And it kind of looks like this. This is a very well-capitalized company that doesn't have a lot of equipment or debt to begin with. This balance sheet is actually an actual client of mine. So under the current standard, there's 4.7 million of working capital, a current ratio of 242. Even at a 5 times case, he's got a bonding capacity of 23 million. He has a debt service coverage ratio, assuming $1 million of EBITDA and an interest rate of 5.5% of 2.32. Usually a bank wants 1.2 is kind of their typical for a debt service coverage ratio. So he passes his covenant that he's got out there for his debt. Under the new standard, he's still very bondable, right? He's got 4.1 million of working capital. He's got still a great current ratio at 2.05. His bonding capacity at 20 million at a 5 times case is still great. However, he's going to fail his debt service coverage ratio because of the extra current liabilities that were placed on the balance sheet. Now, it's important to remember that absolutely nothing operationally has changed with the company. He's making the same payments he's always made. The only difference is where those payments and where those liabilities are showing up on the financial statement. So it's very important to get in front of this and start talking to the sureties and the bankers and renegotiate some of these covenants that are going to be in the balance sheet or in your financial statements from the banks to explain to them that, nothing really has changed operational here. I need you to either lower the debt service coverage ratio or exclude the operating leases so you're looking apples to apples. This next example, this would be a balance sheet more typical of someone that would be like a heavy highway guy that's more capital intensive than that first guy we were looking at who is a specialty sub, he does sheetrock. So this guy is, he runs closer on his balance sheet than the other guy does. He is more capital intensive. He carries more debt, and his equity is lower because he's taken more out over the years. Definitely not as conservative. So what happens here is, current standard, everything looks okay. We get into the new standard, we put the 2.1 million as a right of use asset, the same current portion of that lease liability, the same long-term lease liability, and the balance sheet all of a sudden doesn't look so good. Under the current standard, he's got $500,000 of working capital. He's got 1.1 current ratio. Not great, not horrible though. A bonding capacity of 2.5 million at a 5 times case. Could that be stretched? Absolutely. Debt service coverage ratio of 1.4, so he passes. So, this guy's bankable and bondable under the current standards. However, same operations, you throw those operating leases up onto the balance sheet. He has negative working capital. He's got a current ratio under 1. He's got obviously a negative bonding capacity by standard calculations, and he fails his debt service coverage ratio miserably. So this is a problem, and this is why I think the leasing standard is so alarming and is going to catch people off guard if they're not getting in front of this and addressing it with the stakeholders of the company and those people who work with them. My sources, this all comes from the FASB, ASC 842, and my summary here is to start early, take advantage of the extra year of implementation that we've been given for private companies. Calculate your new lease liabilities. This is going to be a challenge. I didn't show you the actual calculations, but they can be intense. If you only have a few leases, you can probably do it in Excel. But if you've got any more than a handful, you're probably going to need specialized software. There's quite a few companies that have them out there right now. And so either the client, if they're large enough, is going to purchase that themselves, or they're going to task the CPA with doing that. Clients need to get out there, they should be talking with their accountants, or the accountant should be talking with them. Definitely got to be talking to the sureties and the banks, because there's going to be changes, as we saw in these working capital and other ratios. You need to renegotiate your covenants with the banks, but you also need to not be chicken little. You need to remember that nothing operationally has changed. You're either, your analysis has got to change, or you're going to have to back it out, or, change some of, like I said, the covenants. So with that, it kind of concludes this. Again, if there's any questions, feel free to give me a call, email me. I definitely can answer any additional questions that you have. Thank you.